If I had to start from $0 today, I would not look for shortcuts. I would look for leverage. Money is not the starting point. Skills, time, and positioning are. Capital comes later. The biggest mistake people make at zero is trying to invest before they earn. That delays progress and creates frustration. Convert time into income as fast as possible while building future leverage. Step 1. Secure base cash flow immediately. At zero, stability matters more than optimization. The first priority is predictable income, not passion income, but reliable one. This can be a job, contract work, full-time employment, hourly shifts, delivery driving, warehouse work, customer support roles, or on-demand service jobs, or temporary employment. The role does not matter, but cash flow does. A simple rule is allocating no more than 5 to 10% of total net worth to risk capital. If risk capital goes to zero, lifestyle and security remain untouched. This can include individual stocks, startups, crypto, speculative real estate, or new business ideas. Remark: risk capital should be placed in a completely separate account with clear rules. Step 2. Monetize a skill that the market already pays for. I would not start with complex businesses or risky investments. I would sell skills that companies already buy daily. Examples include sales support, content editing, copywriting, video editing, profitable private businesses, social media management, lead generation, customer support, social media scheduling for businesses, website maintenance, or paid ad assistance. The skill does not need to be rare, but useful. Speed matters more than mastery at this stage. I would choose one skill, commit for 90 days, and sell it aggressively. Avoid assets that depend on perfect timing or constant attention. If an asset requires daily monitoring, it is usually low quality for long-term wealth. Step 3. Use platforms as distribution, not as identity. Freelance platforms, job boards, and marketplaces are tools, not careers. I would use platforms like Upwork, Fiverr, LinkedIn, Freelancer, or direct outreach strictly to access buyers. The goal is clients, not ratings. Once income becomes consistent, platform dependence should decrease. Step 4. Prioritize high-income skills over comfort. Comfortable work keeps people poor longer. I would prioritize skills tied to revenue generation such as sales, marketing, traffic acquisition, funnel building, lead generation, paid advertising, analytics, or revenue-focused consulting. And conversion optimization pay more because they produce measurable results. High-income skills are tied to measurable outcomes. Learning uncomfortable skills early compresses timelines dramatically. Step 5. Avoid passive income illusions at zero. At zero, passive income does not exist. Dividends, crypto staking, and automated businesses require capital or systems. Active income funds future passive income. Trying to skip this step keeps people stuck. Step 6. Save aggressively to create optionality. Every dollar earned at the beginning matters. This means living below income, delaying upgrades, and storing cash intentionally like renting modest housing, using functional transportation, and limiting recurring expenses. The purpose of saving is not comfort, but leverage. Cash creates freedom to say no, pivot, and invest. Without savings, opportunity is theoretical. Step 7. Invest in tools, not status. Early money should not go toward lifestyle upgrades. I would invest in tools that increase earning speed. This includes education that improves skill monetization, software, hardware, and systems that reduce friction or tools that reduce time waste. A better laptop beats a better phone. A paid course beats impulse spending. Tools multiply effort. Status burns capital. Step 8. Multiply income before multiplying risk. Before investing in markets, I would focus on increasing earning capacity. Doubling income is easier than beating the market. Skill stacking, better positioning, and higher value clients, adding complementary services, or moving into performance-based compensation produce faster results than speculation. Risk comes after margin. Step 9. Build a simple financial system early. I would separate money immediately. One account for income and bills. One account for savings. One account for spending. This structure prevents chaos and forces clarity. Systems remove emotion from decisions. Step 10. Systematize what already works. Before chasing new ideas, I would stabilize the first income stream. If one service, role, or skill produces money consistently, it should be refined instead of abandoned. Pricing should increase gradually. Processes should become repeatable. Low-value tasks should be reduced. Scaling begins with efficiency, not reinvention. Step 11. Reinvest profits into capacity. Early profits should not be withdrawn emotionally. They should be reinvested into speed and reach. This includes better tools, outsourced labor, paid distribution, or specialized education. Capacity investment allows the same effort to produce more output. This is how income compounds without burnout. Step 12. Introduce business models with leverage. Once income exceeds personal needs, business models become viable. Examples include agencies, productized services, digital products, subscription models, or simple software tools. The goal is not complexity, but scalability. Revenue should grow without proportional effort. If effort scales linearly, the model is flawed. Step 13. Diversify by behavior, not just by asset. Most people diversify assets, but not income behavior. True diversification includes multiple income sources, different asset classes, and varied risk profiles by ensuring income comes from different sources that react differently to economic changes. A common example is combining earned income from a job or business with passive income from investments and semi-active income from consulting or freelancing. Another example is owning assets that respond differently during inflation, recession, or growth periods, such as equities for growth, cash for flexibility, and real assets for inflation protection. One income stream may require daily attention, while another runs with minimal involvement. If one source slows down, the others prevent financial disruption. When one system fails, another continues. This reduces stress and improves decision quality. Step 14. Resist complexity as net worth grows. Complex strategies increase fragility. The more complex the system, the easier it breaks under stress. I would simplify holdings, consolidate accounts, and reduce unnecessary moving parts. For example, holding a few diversified funds often outperforms managing dozens of individual positions. Businesses should use clear operating systems instead of custom processes that depend on one person. If a strategy cannot be explained simply, it is usually fragile. Step 15. Detach identity from financial outcomes. Emotional attachment leads to bad decisions. Wins create overconfidence. Losses create panic. I would treat capital as a tool, not a reflection of self-worth. Clear thinking survives volatility. This includes setting investment criteria in advance and sticking to allocation limits regardless of market sentiment. Losses should be evaluated as data, not personal failure. Step 16. Let time do the heavy lifting. Compounding rewards patience more than intelligence. Consistent execution over long periods outperforms aggressive strategies. I would avoid frequent changes and trust durable systems. Time is the strongest multiplier available. Time is leveraged by minimizing unnecessary changes. This means reducing portfolio turnover, avoiding frequent strategy shifts, and allowing compounding to work uninterrupted. Regular contributions matter more than market timing. Long holding periods reduce taxes, stress, and decision fatigue. Consistency outperforms intensity over decades. Starting from zero today is not a disadvantage. It removes bad habits, false beliefs, and unnecessary complexity. The path is not easy, but it is clear. Earn with intention. Build leverage deliberately. Protect capital aggressively. Let time compound the rest. That is how I would start again.